Hey everyone, welcome back to Corporate Decoder. Today we're diving into some SEC filings, but don't worry, it won't be like reading the fine print on a mortgage. In this video we're going to be decoding the story behind a proposed merger, and there's definitely a story to be told. This time we're looking at GrabAGun Digital Holdings, an online retailer of firearms and related accessories. This isn't your typical tech startup. We are looking at a company that operates in a very specific niche. Get ready, we're about to decode what's in store and the potential future in this merger. First off, this is a preliminary document, meaning things could still change. The report is a combination of a proxy statement which asks shareholders for their votes and a prospectus which offers securities for sale. At the heart of it, Columbia Acquisition Corp. 2, a special purpose acquisition company or SPAC, plans to merge with GrabAGun pending shareholder approval. Basically, Columbia is trying to take GrabAGun public. This gets GrabAGun on the stock market. The deal involves GrabAGun's owners getting stock worth $100 million and $50 million in cash. Also, there's a minimum cash condition. At least $30 million has to be available after everyone gets paid. If that minimum cash condition can't be met, the business combination may not be consummated. If all goes according to plan, the previous shareholders would own 53.9% of the new company. The sponsor, Columbia Sponsor 2 LLC, will own 13.5%. The GrabAGun consultant, Donald Trump Jr., will own 0.9%, and the former GrabAGun members will own 31 and welk fixefi. Theodore Jr. exultant Donald Trump Jr. will own 8.9%, and the former GrabAGun members will own 31.7% of the new company. After the deal, the stock is expected to trade on the New York Stock Exchange under the ticker symbols PEW and PEWW, subject to approval. Here's where it gets interesting. The report mentions that Columbia's directors and officers might have conflicts of interest because they benefit from the deal going through. It might not be best for Columbia's shareholders. The sponsor will make a substantial profit if the deal goes through, even if the stock doesn't do well. That's because they bought shares early at a very low price. This creates an incentive to close the deal, even if it's not the best option for regular investors. Also, the sponsor shares would be worthless if the deal doesn't happen by February of 2026. That alone is $45 million riding on the deal's success. And that's not all. The 5 million private warrants held by the sponsor could expire and become worthless if the deal doesn't go through. That alone is an estimated loss of $3.5 million. The document states that Columbia's officers are getting $60,000 a month, paid through an affiliate of the sponsor until the deal closes. Also, an affiliate of the sponsor is getting $10,000 a month for office space until the deal closes. All in, the sponsor's skin in the game is $5 million, but because they acquired the sponsor shares at a nominal price, they stand to earn a positive rate of return on such investments, even if other Columbia shareholders experience a negative rate of return on their investment. It is important to note that Columbia's board didn't get a professional fairness opinion on the deal, so investors are relying solely on the board's judgment that the price is right. Jumping ahead to the risk factors section, there are several things that could go wrong. For example, the market for GrabAGun's products could decline, or they might not be able to keep up with changes in the market. Let's take a look at GrabAGun's selected financials. Keep in mind that past performance doesn't guarantee future results. In 2024, net revenues were $93.1 million, a slight drop from $96.3 million in 2023. Cost of goods sold also decreased slightly, but this didn't fully offset the revenue decline. The company's net income decreased ever so slightly from $4.337 million to $4.31 million. Let's take a look at how it all looks on paper if we combine both companies. This is very important, and I want you to pay attention. This assumes a worst case scenario with 50% of public shareholders redeeming shares. The maximum redemption is set so that Pubco will receive a minimum of $30 million in cash. This is essential for the company to actually do anything after the deal closes. We will look at the world where 8,955 Fen per share. The projected net loss stays at $527.5 million. But the common stock plummets from the no redemptions world to 22,598,827, which is nearly 10 million less than before. So naturally, loss per share skyrockets to 0.23 to no redemptions 0.1 and 17s per share. Looking into GrabAGun, we can find more about the business itself. The tech stack isn't fully independent as it still relies on telecommunication providers. We learn that if GrabAGun or those who engage with its content experience disruptions in such internet service for any reason, such as the failure of ISPs to provide reliable services, or if ISPs are able to block, degrade, or charge for access to GrabAGun's website, it could incur additional expenses and the loss of traffic. The report also states that the company requires its leadership, specifically mentioning Mark Nemati, Matthew Vidito, and Justin C. Hilty as key personnel, and that they would be difficult to replace, though does not mention any reasons why. As it is very obvious, GrabAGun has to comply with a lot of government rules, so if they failed to adhere to those, this could result in a business hit. With advertising being difficult, they have to rely on social media and email marketing. A 32% email open rate is great to see as a sign of positive customer engagement. Alright, so what's the story here? GrabAGun is trying to go public through a SPAC merger, and the report shows some interesting angles. On the one hand, there's potential for growth in the online firearms market, and GrabAGun has a solid customer base. However, the deal has risks. The sponsor has a lot riding on the deal going through, which could lead to conflicts of interest. Plus, the Colombier board didn't get an independent opinion on the price, so it's hard to know if it's really fair. Financially, GrabAGun's revenues are down slightly, and depending on how many public shareholders redeem their shares, that loss per share could increase if the stock isn't handled properly. The amount of redemptions will also determine the amount of cash on hand, with anything below 30 RM likely voiding the deal entirely. This presents both opportunity and risks for the company, but what is certain is that there needs to be an extreme focus on finances to see them through in the coming months. Avti, so should you invest? It depends. There's a case to be made either way. A successful redemption rate could mean great gains, but a big risk as it may indicate trouble for the company if it wants to make it. That's going to be it for today. If you enjoyed this video, subscribe, like, and comment.